Welcome to the Commercial Real Estate Show. I'm Michael Bull. We hope this show is your source for market intelligence, forecasts, and strategies. Well, today we're going to talk about retail and retail real estate, and what a great sector to talk about. There's been a lot of changes in the retail world. There's been a lot of movement in the retail investment properties and retailers with online and in-store, a lot of things going on. We're going to get to it all. We're also going to talk about ICSC Recon coming up. But please welcome my first guest. It's Jim Costello. He's Senior Vice President with Real Capital Analytics. Jim, thanks for joining us today.
Glad to be here.
And Jim's joining us on Skype. And Jim, you guys do a great job of tracking property sales all over the country. How are retail property sales volume trending right now? It seems like it's a pretty active space.
Well, there's two ways to look at it. Relative to last year at this time, deal volume is down quite substantially. A 31% year-over-year decline in deal volume. However, that's on sales of $17.9 billion for the first quarter of 2016. $17.9 billion is still an elevated level of activity. So one way to look at it is that, this first quarter of 2016, we just didn't have those mega deals, the big portfolio and entity level transactions, nearly as much as we did early in 2015. And it's a hard number to hit if you're not doing those mega deals.
Right. So to put it in perspective, if you look at historic years, maybe even pre-recession, how does it compare?
Yeah, compared to pre-recession years, it looks like a great quarter in terms of total deal volume.
Yeah.
People are always thinking about the last deal they did, though, and they're thinking about last period they were in. And the fact that deal volume is not as strong as it was at this time last year raises some concerns on the part of investors.
Right. What have you done for me lately, right?
Exactly.
What about cap rates trends there, Jim? What do you see there? Are cap rates kind of stable? Are they still compressing a little? What do you see?
Well, that's one of the interesting things for the quarter. If you saw declining volume and cap rates starting to move up, that'd be a big red flag. That'd be a sign of a market where there was weakness and price discovery was pushing asset values lower. Instead, what we've seen is cap rates really unchanged from a year earlier. And with reduced volume, another way to look at it is that buyers and sellers are just moving further apart on their pricing expectations. And in some sense, I look at this as a bit of a hung market more than anything.
Yeah, that's interesting. And we obviously we sell, or maybe not obviously to some of our listeners, but we sell shopping centers all over the Southeast, and and it seems like we're at the top of the market. If you're saying cap rates are pretty flat and pretty stable, then that may indicate that we're at the top of the market in this cycle. But yet we still have some sellers that believe, that it's going to go higher, that the cap rates are going to stay stable or maybe go lower, and if they stay stable, maybe they'll have NOI growth, and they still don't want to sell.
Yeah, cap rates are flat, and you look at that, and some investors, when they hold an asset, they see some ongoing NOI growth, and they understand that they're going to have some value growth as a result. Maybe not the double-digit growth rate in value that they saw over the last 5 years when you had a combination of both NOI increases and cap rate decreases, but even some marginal increases in NOI will drive some value growth. But when I go to industry conferences, the kind of discussion that I get involved in with clients, they tend to have this thought that cap rates are inevitably going to go up. That we're at a record low, it can't stay here forever. Cap rates rise and we all die. That's sort of the thinking that goes on with a lot of folks. And it need not be like that. Right now, if you've got a cash flowing asset with some stable tenants and some growth in NOI, you have no reason to sell. And even if you did, where else are you going to put that money?
You're killing me. I'm a broker over here, Jim. We're talking with Jim
you-
Costello with Real Capital Analytics about the retail investment market. But go ahead, Jim.
No, the brokers are going to have both the hardest time and some of the biggest rewards in this new environment. I mean, the way I look at it, people have been asking a lot of conferences, what inning are we in? What inning are we in? That's been sort of the mantra of late. And I think the question, the answer to it is that we're in a new game now. The last game, we had a good offense out there. Falling interest rates, falling cap rates, drove up prices at double-digit rates. It's a new game, a new set of players. We're not going to have that cap rate compression to the same degree. And with that, I think brokers have a new job that they have to do. In the last game, it was easy. You got buyers, you got sellers. They agree on prices pretty easily. They come together without a lot of extra effort. This market, it is hung with some different pricing expectations on the part of buyers and sellers, and I think the only way it moves is with brokers. I think it's a case of brokers working with the buyers to help them, number one, understand that just because they are a little bit uncertain about where interest rates are going to go, they can't expect current prices to come down 5 to 10% to help them with their uncertainty. And likewise, I think they really need to do a lot to help educate sellers that they may not get the kind of double-digit growth rates that they had seen the last 5 years, and that for them to wait further, that there's not going to be too much in terms of additional gain.
Well,
and that's a challenge for the education.
And let's talk about that for a moment. I mean, what do you say to the folks that say, well, look, interest rates can only go up, and when the cost of capital goes up, it should impact cap rates, at least in some way, if there's not a lot of extra demand from buyers out there for other reasons, right?
That's true. Interest rates should eventually go up. And in fact, if you look at forecasts from economists over the last 5 years, we keep saying that interest rates are going to go up next year. And they haven't. One interesting thing, if you look at, say, the consensus survey of economists that the Wall Street Journal puts together, the thing that I take away from all the revisions over time is the expectation for 2 years out continues to be revised lower and lower and lower. I think that where we are now with the 10-year Treasury around 2%, maybe a little lower, it's something that is obviously unusual. We've never had things quite at these low levels. But that doesn't mean that we have to go back up to, say, the 7% long-run average when you go back to the 1920s. Mm-hmm. There's just a different structure in the global economy today. I think we're in a permanent lower interest rate environment. And in that kind of low interest rate environment, real estate will thrive.
Right. Right. Well, it sounds like you sound like a broker. You sound like one of us. You're saying, hey, for sellers, you might be at the top of the market, and buyers, don't be afraid of rising rates. It's not going to impact cap rates that much, and you should have some NOI growth. So what do you say to the folks who are looking for some distress, that maybe the 10-year loans that were put on in the height of the market and the highest prices coming ballooning in 16 to 17 with these maturities? Do you think there's going to be some distress out there in retail?
We did a study of that earlier this year. We took a look at the CMBS loans originated in 06, 07, the ones that have survived so far. And the ones that have survived so far, you've got some cash flowing assets, so there's something valuable there. That said, the prices at which these assets were bought in 06 and 07 or refinanced at the time, we plotted those benchmark values against our commercial property price indices for the retail sector. We put together an index of prices where we do sort of a same store analysis, looking at when a building sold last to get a true measure of market movements. And so when we do that, in aggregate, it gives us a good picture of where commercial property prices would be. And when we lay it against every retail building tied to a CMBS loan, we could see an estimate of where values would be for that sector overall. And the thing is, a lot of those assets are not quite back at the previous levels for where they were, the previous price levels at which they were originally underwritten. And so that raises a couple problems. There's some buildings, a very small percentage, where you are so far below the previous price that at kind of current lending standards, you're going to have a very difficult time getting a new loan. There's a middle gap where you've seen some price recovery, and you have more in the deal now than when you started, but still not quite at the level that you need to be able to refinance. So you're going to need some mezz or some sort of preferred equity situation, or even maybe just sell it, take what you can, and walk away.
Yeah.
So those are three capital events that a large part of the retail market is going to need in the year ahead.
Right.
Actually, about 47% of all retail loans issued in 06, 07 that have still survived are going to need that kind of help.
47%.
So that 47.
Yeah.
What's that?
47%. So there may be some opportunity. And Jim, we appreciate you joining us. And as always, great information. And stay tuned. We're going to have Jesse Tron on from ICSC. We're going to talk about some retailer strategies and some ICSC previews for Recon in Las Vegas. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. The Commercial Real Estate Show is brought to you by Bull